Okay, so class number 4. Okay, so class number 4. So like I mentioned just a second ago, we're going to go over any of the homework from last week at the very end of class, time permitting. I'm not going to cover that on the front end. And then I asked you to read the Intuit 10K and write in what the ASC 740 reference was to the different sections of their footnote. And I believe, Anna, you sent out the solutions, right? Not yet. And so when she sends out the solutions, actually we have a solution where we did that, it looked like, when I was scrolling through the materials you sent me, right? Yeah, I was surprised we actually did that for you. So that homework the solutions will come back to you with the actual sites, in case you want to check that. So tell me, did you find that 10K somewhat easy to understand, or not? Okay. I think that towards the end of class we'll go through that as well, time permitting, and we'll just kind of scroll from top to bottom of the 10K. I don't want to get started. We spent a lot of time on the 10K last week, and that pushed the rest of class late. So I'm not going to do that tonight. I think we'll cover into it at the end. Okay. Okay. So you've seen this picture a handful of times in class, and so these are the 10 steps to calculating a provision. And if you're keeping track, you should expect that we're all the way through step number 6, right? So in the first few classes we've covered perms temps, the current provision, return to accrual. Class number 2 was largely a combination of steps 2 and 4. And then class 3 was steps 5 and 6. And so tonight we are going to cover steps 7 through 10. Okay. So after tonight, you'll be done with a provision. You'll be able to figure out the whole thing. And like I said, the problem tonight, there's just one in-class exercise, but it's a bigger one. And so hopefully through that in-class exercise, you will have that aha moment of like, I can figure this out. Okay. That is the goal. Okay, so if we're just going through the sequence of the steps, step number 7 is computing a total provision. And I believe we have shown this slide in one of the prior sessions, and it's included here really just as a way to reiterate the same concepts. So total tax provision, right? I think we talked about it has 3 components. It's the tax that you owe currently, right? That's the tax you're going to file on your tax return now. You're going to cut a check to the government. And we talked about the fact that that's a simple journal entry between payable and expense, right? It's the tax we're going to owe now. The second component is the deferred provision. So these are taxes that you will either pay in the future or save in the future, but relate to this year's book income, right? So if something is happening this year, like I'm accruing a bad debt expense, and that's going to allow me to save tax in the future, I'm going to book a benefit now and set up my deferred. That's my deferred provision benefit. Okay? Doesn't affect my current tax expense, doesn't go on this year's tax return, but it does relate to me setting up DTAs or DTLs. Okay, that's anticipating the future. And then the last component is non-current taxes, and we talked a bit about these as largely being UTBs, right, our unrecognized tax benefits. That's one of the things we covered last class. So these are largely a company's tax reserves. These are taxes a company doesn't voluntarily want to pay, but it's exposures a company thinks it might owe if taxing authorities audit a company, right? So if you can understand those three components of taxes, the taxes we owe today, the taxes we'll owe or save in the future because of timing differences, and the taxes we might owe because of exposures, the sum of those will be our total tax expense. Okay? So when you see tax provision on a company's financial statements, you should just know that it's the aggregation of those three things. Okay?
Good question.
Yeah, Timmy.
Is it possible for one person to be in charge of tax planning and provision?
I don't know how you got that from that slide, but that's an interesting question.
I was just thinking about it.
So Timmy's question was, is there a way to work in a company's tax department and not do tax accounting? No, I edited his question slightly. His question was, is it possible to work in a tax department and do tax planning?
And not do tax planning. Well, like do tax provision and tax planning together.
Is it possible to work in a tax department and do tax planning and tax provisions at the same time?
Yeah.
Absolutely. It's very possible.
Is it effective?
Is it effective? Sure. Happens all the time. Yep. You should ask Tracy that question. In fact, when I was talking to Don Scott today, who Don is the number 2 guy over at Yahoo, and we were talking about how he's going to come speak at class, and he's going to speak to you guys totally about career limiting moves when you're doing tax provisions. That'll be like the theme of his presentation. So it'll be in no way technical, but it'll be about like the war stories of his life, because he's had some pretty funny moments. Okay. Next slide. So total income tax or benefit. Gosh, this just says the same thing in words that the prior slide showed in pictures. So I don't think I need to cover it. Maybe some things to emphasize. I think you guys got from last class that if I increase my valuation allowance, right, that's going to create expense. And if I decrease my valuation allowance, well, that'll create benefit. And in case that's even remotely confusing, I mean, that's really as simple as another journal entry, right? Because as I increase my deferreds, as I make deferred taxes go up, right, that's a debit. And a VA release is nothing more than making my deferred taxes go up. So if I have that debit, then the flip side of that has got to be a credit to provision. Right? And if I'm moving my provision down, if that's going lower because my DTAs are going higher, my PBT is not changing, so my ETR will move, right? It's just math. So don't get confused by the valuation allowance being anything more than just simple DTA movement, because that's all it is. Okay? But remember how, like in the first class, I was telling you I want you to try to learn to think instinctively about, if I give you a fact, like the valuation allowance goes up, I want you to think debit credit right away. And the same thing is true here, right? If the VA goes up, think, what's the debit credit? If the VA goes down, what's the debit credit? So like increase in UTBs, what's the debit credit for a UTB? Caitlin, I'm going to pick on you since you were picking on me. Okay, well that doesn't... I'm judge and jury on this one, so don't worry. So what happens if you want to increase your tax exposures? If you were just thinking journal entry-wise, what would you do? Amanda, you can help her. Or not. Well, think balance sheet first. What happens on the balance sheet if you want to increase your UTBs? Well, you want to increase a liability, right? A UTB is their exposure. So you're going to book a liability on the balance sheet. So is that a debit or credit? Right? So then what's the flip side of that? Expense, right? And is that a debit or a credit?
Debit.
A debit, right? So if somebody says, I need to accrue a reserve, you should think, okay, credit, liability, debit, expense. If they say, I don't need a reserve anymore, right? Amanda didn't catch what I had and statute lapsed. I should think, okay, I had a liability, but now I can get rid of it, so I can debit my liability, and to balance my entry, I'll credit expense. Right? You should just be thinking all the time like that. I mean, you can do what my kids do and like create little flashcards if you want of like different events and think debit, credit from those events. Okay, statutory versus effective versus blended rate. So this is definitely a repeat. So statutory rate, that's the enacted rate, right? So for U.S. corporations, 35%. Your effective rate, so there should be no confusion with this group by now, that your effective tax rate is going to be what people report for financial accounting purposes as the ratio of your tax expense divided by pre-tax income, right? No one will goof that, please. And then the blended rate, you know, we don't use this a ton in this class, but it'll find its way into our exercises and the materials tonight. But if somebody says, well, what's your blended rate? They usually mean the combination of your federal and state rates. And because you get a federal deduction for state taxes, it's not simply adding up the federal and the state rates, but it's also baking in this benefit, which is simply 35% of the 7, right? That's all that is. Okay, anyone confused on what rate is what?
On the valuation allowance, that was the, like, when you first established, credit the valuation allowance, and is it debit expense as well?
Absolutely. Okay, we're going to do a simple problem together. All right, so remember, the goal of this kind of section of the class is we're trying to figure out the total tax expense, but what you'll find out of this problem is it's kind of similar to some of the relatively straightforward exercises we've been doing. Okay, so assume a first year of a company's operations, which is great. And we have net income of $1 million, which is after federal tax of $300,000. Okay. And we have the facts that are listed here in terms of items that are going to give rise to a book tax difference. And these are our questions that we're going to try to answer. Okay. So I think we're going to try to do this one together, and we'll just kind of keep class rolling as opposed to me stopping and having you do that. But give me a second to get the problem out so I don't have to flip between the slides. Okay, so our first task is to compute the current. I mean, we're essentially going to compute the current, the deferred, and come up with a total provision. Okay. Okay. So if I was computing my current provision, my PBT, how much is my PBT? $1.3 million, right? Because I had $1 million of net income, but that was after tax of $300,000. So I would have $1.3 million of PBT. Right, my meals and entertainment is going to be an add back of $5,000. My fines and penalties will be an add back of $2,000. My $199 deduction, I will get to deduct $14. My depreciation, is that an add back or a deduction? Deduction, right? $75,000. 263A cost. Who knows what a 263A cost is? Yeah, Susie, tell us more about that. What is that?
You hang more stuff on the balance sheet for the 263A than you wrote in your inventory.
Right, you take G&A costs, what people call G&A costs for books, and you capitalize them for tax as inventory. And you deduct them through cost of sales, basically. So it's a way of deferring G&A costs until a later period when you sell your inventory. So we're going to add that back. Bad debt accruals, you got to be getting tired of that example. So we're going to add back 45. And accrued bonuses not paid of 30,000. Okay, so we have a taxable income before our state tax deduction of $1,343,000. And I mean, the way the format for this problem works is it kind of does the federal and state together a little bit. So I've been teaching you to do state completely in a vacuum, and then when you're done with state, go do federal. And I think you should still do that, but the way the format of this works is kind of blends it a little bit. Our state rate was 7%, which means our state current tax would be 94,010. So then our federal taxable income, so we're going to assume that our state taxes are currently deductible. So if we take that and say that's what that line's going to be, our 1343, and we take a deduction for 9410 means that this is going to be 1248,990. And our federal tax rate is 35%, 437,147. Okay, so our current tax expense is going to be the sum of our state tax, which is that guy, and our federal tax, which is that guy. And that number is 531,157. Okay? Current tax. We all good with that? Somebody asked as we were kind of assembling for class whether you could use Excel on the exam. And this is maybe a good time to mention that because you could see how slow it is to kind of go through this by hand. So the answer is yes, but then you need to turn in the problem by hand, and you need to turn it in during class. So if it's more efficient for you to type it in Excel and then re-handwrite it out on a piece of paper, that's fine by me, but that doesn't sound like the most efficient thing to me. Okay? Okay, so that's our current provision. Okay, so conveniently we have the solution in neater handwriting on the next page. But I wanted you to, again, just kind of see the process of pulling it together, right? Because just looking at the solution, I don't know that has the same effect. Okay, so that's our current provision. That should be pretty straightforward, right? So if we were computing a journal entry off of that, Andy, what would our journal entry be? Well, do it together. Key off the green numbers. What's your journal entry off of the green shaded numbers here?
Debit to current income tax, $531,000.
What's your credit?
Current tax liability.
Current tax payable, right? Okay, boom. Good. Okay? Okay, so now we're going to compute our deferreds. Okay, we did our current calculation. Now we're going to figure out what our temporadums are that are going to either save us future tax or they're going to create a future tax obligation. So bad debt reserves. So Jing, is that bad debt reserve add back of 45,000, is that going to save us tax in the future or cost us tax in the future? Way louder. Save tax in the future. You're just like revving your engine. That was good. Okay, accrued bonus. Janie, is that a future deduction or a future source of taxable income? Future deduction, right? So that is a... Oh, I put it on the wrong line. You guys aren't even paying attention. You guys are getting it. You guys want that Red Bull really bad, so if you're like despondent, then they won't notice. Okay, so then the accrued bonus of 30,000. Okay, depreciation. Lena, is that a future deduction or future taxable income? Taxable who? Taxable income? Yeah, you could be sure of yourself, yeah. Okay. And inventory 263A. Kevin, is that a future tax deduction or future taxable income?
Deduction.
A deduction, right? Because now your inventory has a higher tax basis than it does a book basis, right? Because you've capitalized more costs to it for tax purposes. That's the idea. Okay, so our cumulative difference in our taxable temporary difference column, we've got 75 grand, and we have 125,000 as future deductible differences. Right? Okay, so the way this problem works is it calculates the deferred using a blended rate, which, again, this is kind of why I said earlier that here we're kind of combining jurisdictions as opposed to doing federal and state. But a couple of you have mentioned this in class when we did deferreds, and we talked about Fed and state net of federal. So all this, the way the format works here is we're just doing state net of federal effect plus federal all in the same calculation, right? We're just taking two calcs and meshing it together. So if I was calculating my deferred liabilities, I would take 75 grand times my tax rate, and that would be 29,663. And my deferred asset would be 49,438. And my net deferred tax asset would be 19,775. Okay. All right, so if I was computing a journal entry off of that, it looks so much neater when it's typed. What would my journal entry be? So, Shu King, what would my journal entry look like? I cannot hear you at all, Shu King. Hold on, talk way louder still. You're going to debit your income tax expense. So think balance sheet first. Credit deferred tax liability for how much? 19775. Is that what you said? So that 19775 is actually a net deferred asset. Right? Okay, so let's try that again. So what would you do on the balance sheet? Okay, and then what would you credit? Okay.
Wouldn't you do it in pieces? In other words, what you're doing is you're combining the DTA and the DTL together. Don't you?
Yeah, the way the rule works is in any one jurisdiction, and I think we talk about this in like a couple dozen slides. The way the rule works is in any one jurisdiction, so let's say we're all in one jurisdiction here, you take all of your items that are current and you net them. So the way you determine whether a deferred tax item is either current or non-current is by reference to the underlying asset or liability it relates to. So bad debt reserve, this is a current asset on your balance sheet. Bonus, that is a current liability on your balance sheet. Depreciation, your fixed assets are non-current on your balance sheet. Inventory, that is current. So you would take, if you were netting current and non-current, it just so happens that this is all going to be current, and this is all going to be non-current. So if you were applying the rules precisely, and this little nuance I'm much less concerned about in class, but if you were applying the rules correctly, you would actually book the non-current DTL for depreciation separate from the DTA for the other three items. Okay, because anything that's current, whether it's a credit or a debit, it all gets netted. And everything that's non-current, whether it's a debit or credit, it gets netted. And you do that same netting in every jurisdiction separately. So you would net in the US, you would net in Mexico, you would net in China, and it's entirely possible that you get all the combinations by the time you add up a lot of jurisdictions. But again, for now, I'm not that concerned with getting the gross balance sheet right. I'm more concerned with just getting the flow of a balanced journal entry going. Okay? Okay, so we computed our change in deferreds as our deferred provision. So our total expense. Okay, so we should be able to take our current expense, which was our 531,157, and our deferred expense, right? So we know this is a debit, and our deferred expense was 19,775. So, Michael, is that a debit or a credit?
Michael?
Oh, Mike. The look overrules the words.
Is that about the tax expense?
Right, so if I'm adding up my total provision, now's the time I gotta get the signs right, right? Because it's pretty easy to mess up the signs and go the other way, and then all of a sudden our rate rec won't work. Okay, so if my 531, I know that's an expense. I gotta cut a check for that. That's credit liability, debit expense. But the deferred thing is a little more abstract, right? That's harder to put your hand on in terms of whether it's a debit or a credit. So does that 19 increase my expense, or does it actually offset the 531? Which direction does the 19 go? Mike goes with the 50-50.
It's a 50% deal.
Yeah, it's a credit, right? Because when we went back here and we did our journal entry, we were saying that over here we're going to credit our provision, right? Because we're going to increase our DTA balance. We actually have a deferred expense benefit. So that 19 will actually be a credit, and our total expense will be 511,382. I know that might seem fundamental, but it's that type of thing that when you're doing the exam, you'll get sideways on, and you'll flip a sign, or you'll get a concept just a little bit off, and then all of a sudden the whole rest of the problem will go in a tailspin. That's basically what will happen. Okay? And the way you'll prove whether you did it right or wrong will be through the rate rec. And I suppose you could do the rate rec wrong and the problem wrong and still make it work, but you would get points for creativity, I guess, if you did it that way. Okay. So, we have our total expense of 511, and remember we said, well, look, the only thing that really drives our provision is book income plus perms. So if we tested our provision by looking at book income plus perms times our blended rate, we should get the same 511,382. And because I already know what the answer is, I know we get that answer. Well, that 7 should be an add back, right? Because this was meals and entertainment partially, and it was partially fines. So those guys were bad guys, right? They were increasing my tax because they were add backs to income. So if you thought about it as that 1.3 is, I'm going to start with the assumption that I'm going to pay tax on my pre-tax income, but my tax liability is actually going to go permanently higher because I have these expenses I can't deduct. So those bad guys should make my tax expense increase.
slides, you subtract that 7,000.
Oh, I do? Oh, yeah. How did we get that all wrong? Oh, you're right. Oh, duh. Okay. So, Lena, that was a good catch. You're like out of the running for the Red Bull because you're paying attention.
Actually, I have one question about this one. So, this is a kind of method to check whether we are either right or wrong, right? Can we do another way? So, first we set our total income tax expense through this way. So I only take into permanent difference into account. So I got this 1.3 million deduct with 7,000, and then I got my blended statutory tax rate, and then I can get my income tax expense. Does this always work? And then I figure out the DTA or DTL, and then I get my current tax liability.
Well,
Will this work? Or
you should be able to calculate your provision multiple ways. So this method of computing the provision, this concept of this little kind of section right here, people would refer to this, and this is even before my time, believe it or not, people would refer to this as APB 11. And APB stands for Accounting Principles Board. It was basically a type of FASB guidance that existed way back when. And APB 11 basically said you can compute your provision first before you even do your balance sheet. And the way to do it is by taking your book income plus perms times the tax rate. That will get...
tax rate, if we have from state, federal, several states, we just calculate that from the state.
Right. And you can see that the tax rate that they're using is the statutory rate, right? So they're saying if you just take your book income, right, this guy, and if you add the perms, what you've identified here is basically your income that is permanently taxable, right? And when you read the guidance, it's a little confusing, but when they refer to something called book taxable income, that's this. That is your profit before tax plus permanent items. That is the amount of income that is going to be permanently subject to tax. Okay? And if you take that times the tax rate, you'll get your provision, which when FAS 109 came out, and that's the predecessor to ASC 740, it basically said, oh no, figure your provision, or figure out your balance sheet first and let the provision fall out. It's just 601, half dozen of another. I mean, you have the same three variables between payable, deferreds, and provision. And instead of starting with the balance sheet and getting expense, APB 11 said, well, figure out your expense and then go sort out your balance sheet. So it should, in a simple case, be the same answer. And when I started, when I was your age in the firm, like a person at my age now would always think APB 11. And that was just the way it was. Right? So what I thought of as old people at the time now would they would be thinking book income plus perms tax rate equals provision. That's how it is. Okay? You guys can tell Lee you were doing some APB 11 stuff tonight, and she'll be impressed. Yeah.
Let's rotate back a little bit. I can't get the 39.55 rate. If you take 35 times 0.7%, you get 0.0245. And so if you add those together, that's 35, 36, 37.5. So how do you get 39?
The 39, the blended rate, I'm jumping
35.
I'm jumping ahead, but the 39.55, it is the combination of the federal rate
Yeah.
plus the 7, that is the state rate,
Oh, you added the two together.
minus the fact that for federal purposes you get to
Oh,
deduct the
okay.
state taxes.
Okay. Now I understand. Thank you.
Okay. Okay. So that's essentially where we left off. So, Lena, you made a good point that I had missed the 199 deduction, which was buried in that 7. It's still 7, it's just going the other way, which is a coincidence. Right? So the next part of the problem was to do the journal entries, but we did those along the way. right? So we said for our current entry, we're going to credit the payable and debit expense. And for our deferred entry, this shows it gross. You know, we talked about it a couple different ways earlier. But this shows you getting the balance sheet right and then letting the provision fall out, right? So we actually have that is a credit to the provision. That's what I was asking Mike earlier. That's the credit to the provision that allows us to set up the deferred tax assets that are going to save us tax in the future.
Because last time you mentioned suppose we should sell it that stage first and then February and then sum them off.
When we do the problem tonight together, we're not going to do this blended rate thing. We're not going to do this. We're going to do state first, and then we're going to do Fed second. Okay? And I think you'll find that if you try to do more complex problems in the homework or in the exam or in the take-home and you try to start blending it, you will get confused. So this problem is fairly straightforward, and there's not a ton of moving parts, but I wouldn't suggest using the blended rate approach. Okay? I'm just kind of showing you another way of doing it, though. Okay? Okay. So I think that's probably it for our step 7, which is calculating the total expense. Okay, I just wanted to, through that problem, reinforce the concept of the current provision being separate from the deferred provision. And if you add them all up, you should be able to think of journal entries separate for the current, journal entries separate for the deferred, add them together. Okay? Okay, so what we're going to do next is we're going to start working on the problem. And what we will do, so Anna, if you haven't already, will you email out? Yeah, you can, although honestly, I guess we haven't sent them, I don't have a blank one. So let me have you guys do this by hand, and then I'm going to show you the solution in Excel. Okay? And then after that, I will give you the Excel file, and you can work on it that way. Okay. So I think we passed out the problem, right? So you should have an email that has a set of facts that looks something like this. So this is the provision for De Oro Corporation, which is another San Luis Obispo reference. And the way the problem is laid out is there's a section here at the top that says year 1. And so I want you to be thinking about how would I do a provision based on these facts, right? How would I do that provision? And don't move on to year 2 yet. Just worry about year 1. Because what we're going to do in a bit, after we finish year 1 and after we agree on the answers, then we're going to go and true up year 1. We're going to say, oh, we filed our returns, it was different, let's true it up, let's fix it. And then we'll move on to year 2. But let's, for now, just do year 1, okay? So, work in groups, right? You guys are pretty good about sitting next to people that you don't know. I'm paying attention for the record. And so work in groups of 2, 3, and 4 and try to figure out the year 1 provision. Do the current provision, deferred provision, and then do a rate rec. Okay? Okay, so during the time that you were working on the problem, so Anna sent you an Excel file by email, which is this Excel file. Okay? And as I mentioned before, this is a major buyer beware exercise. And I'm not kidding that I have used this Excel template since I was like probably Ellen's level at the firm. I mean, what do you have, like a year experience, right? A buddy and I, in the Orange County office of Deloitte, when we first started, we created this little Excel file, and I've used it ever since. And he's now the head of the Orange County office, and I'm here teaching you guys, and we've both been around a long time. But I still use this model because to me it makes perfect sense. And he and I used to spend so much time with this. We would always, when we were faced with provision questions, we would always be like, what does our model do? And which is complete, like, ass-backwards way of thinking about it. So I don't want you thinking about it that way, but it just shows you how, like, institutional in our heads, like, the mechanics of a provision would get. Okay? And you don't need to follow this provision model. In fact, I would be happy for you to create your own. But again, I'll show you this just so that you can see kind of what a Excel file might look like. All right, so the way this is set up, you can see from the top here that everything is in debit credit form on this page. Okay, so you can see debit credit. Okay, that is key. Debit credit. Can you guys see this? Okay. Look harder, because if I make it bigger, I can't fit it on the video page. So I'm going to want you to be able to see it on the video. Otherwise, I got to like scroll back and forth, and I think that's going to be tough. But tell me if it's really, is it really bad? No, I think you guys could do it, don't you think? Yeah, okay. What do you think, Michael?
It's kind of small, like.
Okay, well, follow along. So most of you guys have computers, so you can do it along with me as I go, and then I think you'll get the hang of it. Okay, so this thing is meant to be debit credit, right? And if I start looking at my problems and I just take each fact one at a time and I think debit credit, okay? If I have book income and I'm going to compute a journal entry off of book income, Rohan, what would be my journal entry? Don't worry about the number, just think debits and credits.
The debit, what's that entry?
What's the entry for just having book income of 10 million bucks?
Credit.
Credit what?
Income for 10 million.
Oh no, sorry, what would be my tax entry? If I just told you I had 10 million of income and I said, what's my tax entry that results from that? What would my tax entry be?
Debit, income tax expense.
And credit what?
Income tax payment.
Okay, so I'm going to credit my income tax payable. Okay, so I put a credit in the column called state tax because that's going to be my payable column. Okay, and if you want to relabel these to make it clearer for you, that's perfect to me. Okay. Okay, so I got to make it bigger. I can tell.
I think 10 million, right? Just another top.
Yeah. So hold on a second. Let me hide the federal piece, and we're just going to do the state piece, and I will give you the gift of size. Okay, is that better? Is that better? Yeah? I feel like an optometrist. Okay, so for the 10 million of income that I have, the journal entry that I would book would be a $10 million credit to payable. This is pre-tax, and a 10 million debit to expense. So this column right here, that's going to be my provision column. This will be my deferred column, and that will be my payable. And for every fact I create, I'm going to come up with a journal entry. Even though I'm doing this pre-tax, I'm going to do it in a way that balances. Okay? So this line so far, this balances, right? Once I apply a tax rate, I'm going to have a balanced journal entry just for book income. Okay? What I call book, which I realize this is unhelpful, but book is provision. So if I were you, I would go type in the word provision and replace book. And then the column called def is deferred. And the column called state tax is payable. And APIC you won't need until next class. Okay? So if that column's 0, you're doing great. Okay, so I have a balanced journal entry for row number 1. Everyone with me? Linda, you with me? Wonderful. Okay, So if I have non-deductible penalties of 20,000, Andy, how would I book a journal entry in my little Excel thing to get the penalties in here? What would be my debits and credits of my 3 columns? Non-deductible penalties. How is that going to affect my payable, Andy? It's going to get added back to income. So is that going to be a debit or credit to my payable? Credit, right? So I put in a credit to non-deductible penalties, and through the miracle of this highly automated machine, it already knows to put the debit over in provision. I'm being sarcastic. This is like basic Excel here. Okay? So we added a fact, we created a journal entry from it. Okay? Very basic. It balances. I'm happy. Are we good with that? Okay, increase in bad debt reserve of 45,000. Yolanda, what would be the journal entry I would create if I was going to increase my bad debt reserve for 45,000? How would that affect my payable, Yolanda? I'm going to add back my 45,000. So is that a debit or credit to my payable? Credit. So what's the other side of that entry going to be, Yolanda? So if I'm going to credit my payable because I have a bad debt reserve add back, what am I going to do to balance that entry, right? I have to have all these rows balanced. Am I going to debit your current tax expense? But I kind of shortcut this here. So what do I have to do on the balance sheet besides set up the payable? The DTA, right? I've cheated, but I showed you where the zeros are. You can kind of see where the formulas are. So I've credited my payable and debited my deferred, right? So if somebody goes to you and they say, oh, I got an increase in bad debt reserve, how does that affect the provision? In theory, you think of the schedule and you think credit payable, debit deferred, balances. Okay? And nothing's hitting the provision column, which makes sense, right? Because temporary differences aren't going to drive the provision. Okay? Tax depreciation in excess of books. Dan, what would I book for my tax depreciation in excess of books? You can't see. Well, what journal entry would I book if I had tax depreciation in excess of books? Well, how would it affect my payable? How would having more tax depreciation than books affect my payable? Or you debit your payable, right? Because having more tax depreciation than books will save you tax, right? So that means your payable will be lower. It means you need to debit your payable, right? So I'm going to put in 300,000 of what looks like a debit to my payable because I'm going to save tax. Okay? You know, my guess is we could actually wheel this thing back and make it bigger.
Is that better?
Much better.
Reduces your payable.
Yeah.
What you need.
Not very stable. Sorry, one more time.
So Yolanda's question was, if I entered in the deferred column, would it enter in the other side? No, no, it won't do that.
So you gotta know.
Right. So if I had my druthers, I'd give you a spreadsheet with completely no formulas and no numbers, and you could figure it out, right? But I want you to be able to think balanced journal entry, okay? So for tax depreciation in excess of books, it'll reduce your payable, and it's a timing item, so it'll flip in the future, and that'll create a taxable temporary difference, right? And that's why there's a credit in the deferred column. All right? Okay, next fact. Meals and entertainment of 80 grand. So, Jenny, what do I do with meals and entertainment of 80 grand? You increase your expense and your payable. So I'm going to put in 40,000 of payable, and that's going to increase my expense, right? Okay, so I think I've got taxable income done, right? So my taxable income is 9805, and that's the income I'd expect to show up on my tax return from a state perspective. All right, I don't have any NOLs, so my state tax rate. So I'm going to do all my states together. So if I just combine Michigan, New Jersey, and Tennessee by multiplying tax rates and apportionment percentages, and just do the math, this rate is 0.0855. Okay. So when I do that, it'll tax affect my entry. And now I have credit. So Jesse, what do I do with credits? What's my journal entry that balances for credits? I took the formulas out, so you can't even cheat. Debit to the payable, right? Because you're going to save tax. All right, so that's 42,000. Okay, and so what's the other side of that entry? I can't hear you. It'll reduce income tax expense, yeah? Okay. So the credit entry would be in the provision column, right? Because it's a permanent difference. It's going to permanently reduce the amount of tax that I owe, right? So you saw when I typed in that number, it actually shot something over to the APIC column, right? And so that would be wrong. And so if you're doing a provision and you use my template and it does it automatically, then you should not assume that it's right. Okay. I can think of cases where having a credit can go to APIC, but that's way past like what we're talking about so far. And so the answer is just having a basic credit would be debit payable, credit provision. Okay, so we just did our state provision. We're done. Okay? So we have a balanced journal entry, right? So I sum up those debits and credits and it puts to 0. That is good. So now, I mean, one of the biggest problems when you're doing a provision is you get out of balance. If you do it like this, you cannot get out of balance, right? You ought to be able to go to the row and figure out what is causing me to be out of balance. And if you're doing a rate rec and you're saying, well, I got to explain this 818, well, you could just kind of roll up and figure out what's affecting your provision, right? It's in the provision column. You know, have I accounted for the penalties? Have I accounted for meals and entertainment? Did I get the credits? There's nothing else there, right? It's all there waiting for you, though, to kind of figure out. All right, so we have a journal entry for every fact, basically. But at the end of the day, this 796, this is our step 1 that we keep referring to. And that 21, that's our step 2, and the 818 is what falls out. Okay, any questions on that? So, sorry, you were asking in cell J45, which G45? Okay, what was your question about it? Wouldn't it be better if we linked it to the payable column? Sure. Yeah. I don't care right now if you hard-code it or if you link it or whatever you do, but every row better balance. Okay? Okay, that's our state provision. Okay, so now we're going to do our federal provision. Okay, so you can see that some numbers are already kind of popping into the picture here. Right? So some of them aren't linked, some of them are. So I would go through and put my book income in, and my meals and entertainment, my penalties. I'm going to come back to state tax in a minute because that's the hard one. Okay. So now the way I've calculated, I've put all the Fed and state differences being the same, except for that line called state tax, right? Because that's my only difference. So this is confusing. It's simple, but it's just mind-bending. So if I'm on a method where I'm going to take a federal deduction now for my state taxes that I owe, and this is where having the screen the way it is going to be a problem. Shrink it down just a little bit. I know that's small. So if I have said earlier that my state tax expense is going to be this $796, that's the amount that I expect to pay on my state tax return. Okay, how much is my federal deduction for state taxes, gamma? $796. All right. So if I link that, is that going to cause my federal payable to go up or down? Fong. She's trying to win the Red Bull contest. So if I was going to claim a federal deduction for state taxes, like Gamma just said, of $796, is that going to make my federal payable go up or down? Down. So I want that number to be a debit, right? So I'm going to link my provisions. So I claim a $796 reduction in my federal payable, right? Before tax effect. So if I have a credit on the state side, I'm going to have a debit on the federal side. So now you can see the way this formula is working. I mean, this formula is a little tricky, but the federal provision benefit equals the reverse sign of my state provision. Because my state provision, at some point in the future, I'm going to get a federal deduction for it. So there's a federal benefit for that. My state provision I calculated to be an expense of $818. Someday, I'm going to pay $818 of state taxes. $796 today, $21 in the future. But over time, over the life of this company, I'm going to deduct $818. So I'm going to claim a federal provision benefit for $818. Okay? So I claim my federal benefit of the current deduction through my payable. That's going to save me tax now. I'm going to claim my federal deferred benefit for state taxes through my deferreds, because I'm going to save federal tax in the future. right? When I pay that extra state tax, I'm going to save more federal tax. And therefore, my total federal provision benefit for state tax is the sum of what I'm going to save today because I'm deducting state taxes and what I'm going to save tomorrow because I get to deduct state taxes. Okay? So this 796, this is me saying I'm saving money today. Good for me. This 21 is I'm saving federal tax in the future when I pay state tax. That's great too. And the 818 is the total federal deduction I'm going to claim ever for this year's state tax provision. Okay? So all that formula does is just a link from the bottom of the schedule. But what you got to be careful about is just trusting like the links, right? You need to know why it's doing what it's doing. Because if that broke, or let's say I take that formula out and then you can't figure out how to do it, then that's a problem, right? So that's a balanced journal entry, and that's key, right? You got to have a balanced journal entry. Patty?
I've seen it before where I've been told state taxes do not have a deferred balance, and that's how it's treated. But here you're creating a deferred balance. Why would I didn't understand it then when someone was telling me that years ago, but I never quite understood that why.
I always feel like having a guest teacher when I do this part of the class. Like, this is such a frustrating topic for people. All that 21 represents here is, in the future, what this state DTL tells me is that I'm going to pay state tax. And when I pay state tax, I'm going to deduct it for federal. A lot of times what people do when you pick up a provision schedule, like, you know, have Neil show you his provision schedule if he does it, not you. He will probably show you this 21 already net of the federal effect. That's typically how companies do it. But what they're really showing you is a gross state DTL and an offsetting federal benefit. And I want you to think of them separately because federal and state are two different jurisdictions. And if we start combining it, it gets confusing. That's what most people do. They will calculate all their deferreds and they'll just stick a state rate at the bottom to calculate the tax effect, and they'll do it net of federal impact. But it's not the right way to learn. I mean, the right way to learn is do the state provision completely independent of any federal effects. Get it right, do a rate rec, make it balanced, and then go do the federal piece. Okay? When you have some fancy spreadsheet and it's all automated and the formulas are working great, you can do all that kind of fancy stuff, but not when we're learning this way in class. You can do it however you want, honestly, but if I were you, I would learn it state completely divorced from federal. Okay? All right. How are you feeling, Caitlin? Federal effective state is very confusing. I have spent so many hours thinking of this row in this spreadsheet and kind of processing in my mind, like, what the logic is. And trust me, when you throw in stock compensation and there's some kind of APIC entry, which is Fed effective state, it gets really complicated. The key, though, is first figure out your state, know your journal entries, and then think, well, what would the federal effect of my current state payable be? And the effect is I get a deduction. So, boom, I take a deduction. Well, if I'm going to pay more state tax in the future, what's the effect going to be? I'm going to get a future federal deduction. So I'm going to set up a Fed DTA. And I'm going to let my provision fall out. And that provision, anytime I expense $1 of state income tax expense, I would expect a federal benefit for each $1 of state expense, and that's what this is doing. If you get frustrated with this, though, just know that it's frustrating. So don't be hard on yourself. Yeah.
This whole class is frustrating.
This is awesome. What are you talking about? If you did the lag, okay, so let's just play that out, right? So if you were on the lag method, so Caitlin, what would you do if you were on the lag method, other than like pull the parachute cord? So that's probably going to be 0 then, right? Or O. Putting it 0. So then I'll get a future deduction for the whole A18, right?
What's the lag
Exactly.
method? What's the lag method?
The lag method, Timmy's question is, what's the lag method? The lag method is, if you pay $1 state tax this year, you don't get to deduct it for federal this year, you deduct it for federal next year, which is how California taxes work.
We're tax-based taxpayers.
Yeah. Okay, so let me pause this and then set up a new recording here.